Yeah.
Okay, let me go down there to get to the instructions. Yeah, I'll offer the prayer.
Okay.
Our dear Heavenly Father, we're very grateful for all the many things we were able to accomplish this week and for the safety we've had with work and travel and other things that we may be going through. We pray that God will bless us that as we discuss this case study that we'll be able to have a productive conversation and be able to gain a greater understanding of how um, all of these things work for evaluations and different rounds of investments and these things. We ask and pray in the name of Jesus Christ.
Amen. All right.
All right. So spiritual thought. Friday, I had the opportunity to go to my grandfather's funeral. He was 95 years old, and one of the things that really kind of stood out to me from that is his dedication to home teaching. Um, I think sometimes to myself, like I'm so busy, I'm working, I'm going to school, I'm working some more, multiple jobs and whatnot. And honestly, at this point, I'm gone so much that my ward hasn't even assigned me, even though I initially asked for a family.
Mm-hmm.
But my grandfather has been to the point where, in the last 10 years, he's had a heart attack and stroke, and he fell down and crushed his skull. And, he's gone through a lot of stuff, and he's been not hardly able to move and get around. But one of the things that they talked about at the funeral is that even though all those things were building up, and his mobility and his abilities and strength and whatnot were just really depleting, he still did his home teaching last month, and he'd been doing it every month, according to his bishop, he was, one of the most dedicated home teachers he'd ever met. And I just, thinking to myself, if I was 95 years old with water on my lungs and, completely just tired and weak, would I be going and doing my home teaching? And, just thinking about what level of dedication am I pursuing? And am I living up to the legacy of my grandparents and those that went before? I don't know. Maybe more depressing than spiritually uplifting, but something to think about.
Yeah, no, that's absolutely true. And I was working in Ohio this past week, and we stayed the night in Independence, Missouri. So
Oh yeah, that's like.
Yeah, so I was gonna try and hit up, Liberty Jail and everything like that. We ended up getting into town too late. But during the drive, I was reading a whole bunch about, the early saints of the church, and that was, a testament to me. Just like you said, we got to live up to the struggles that they went through. I mean, we're not just doing it for ourselves; we're doing it for everybody. So.
Yeah. Yeah. Well, Independence is about 45 minutes to an hour from my house.
Oh, is it? Okay. Where are you?
I'm south of Kansas City, about south and just a little bit east in Clinton, Missouri.
Okay.
So I wasn't here. I was in Florida.
Oh,
then I was in Arizona, and then I was back here. So, like I said, it's been a busy week.
You sound like me. I was in West Texas, then I flew to Pittsburgh, drove to Ohio, did a job there, then I drove from Ohio back to Texas. And now next week I'm flying to Idaho, driving to Seattle, and going to a football game, and then driving back to Idaho and flying back to Texas.
Yeah. Yeah. Mine's not quite that busy this next week, but I worked a 12-hour shift today. I've got a 12-hour shift tomorrow morning, from 7 to 7. And then after the 7, I've got to drive to St. Louis. And I'll be in St. Louis Monday and Tuesday. And then I drive back on Tuesday so that I can work on Wednesday.
Yeah.
I mean, all that's for, it just doesn't seem to stop.
Yeah.
But anywho, yeah, I'll tell you what. Someday life will slow down, and then we can, the mentality is someday life will slow down, and then I can be a better saint. And unfortunately, I think the problem is that I just need to be the better saint.
Yeah.
I just don't know how to do that.
Yeah, that's going to be the hardest part. So I think life's always going to be busy.
Yeah. Anywho.
Okay.
Let's see here. What does BzzAgent do? What need is being met? Well, they're an advertising company that uses word of mouth. And really, what are they doing? All they're really doing is facilitating people talking to people and making reviews. That was the thing that was interesting for their business model. They're not actually paying people to do the reviews.
Yeah.
They sell them a product, so that's their payment. And then for the payment, for their product, they provide a review. Sounds like a kind of deal that I need to get into. Send me some hunting and fishing gear, and I'll review it and keep the gear.
Yeah, there you go. And tell all your friends about how good it is.
Or bad. Yeah.
Yeah.
So really all they're doing is facilitating the in-between, because honestly, people do that on their own. They're just making it more guaranteed. Maybe that's the word I'm looking for. They're just ensuring that it happens, I guess, is what makes,
Yeah. Yeah, and it's kind of interesting how some companies, I said Procter and Gamble has its own division of it. But it's weird that more companies don't have their own, their own marketing section for word of mouth. But it seems like it's so small that they're probably not even concerned about it. So.
Well, it's very effective. It's just extremely, if I sell you something and you don't on your own come and give me a review, how are you going to look at me as the seller if I keep hounding you for a review?
Yeah.
At that point, it's like, dude, leave me alone. I'll review it if I want to. And giving them a product, I think that only works if your product is fairly cheap. You know what I mean? Like an ATV store. They can't send out like 15 ATVs and say, hey, here's a free ATV. Do a review. You know what I mean?
Yeah.
To an average person. You know what I'm saying? But if it was going to be one of those like toothbrushes that we talked about at the beginning of the semester, shoot, man, send those out to 1,000 people. They cost what, $2 a piece? Here, take it, try it. Give us a review. So I think the product, the product type makes a difference too.
Yeah. So, yeah, that's very true. I never thought about that. It's hard for, but at that point, maybe they could, if it was an ATV or somebody, maybe give it to a professional writer.
Yeah, and they do that.
Yeah.
Magazines write articles about their stuff all the time. But those guys are then the professionals. It's not like it's no longer the word of mouth. It's, I don't know, just a different dynamic of the, I don't know how they make that work.
Yeah.
But
yeah.
Maybe they could, they could give free gear to the people, like, hey, you bought an ATV, here's a free gear for doing the review. At that point, they've already bought the product. but now they're encouraging them to do the reviews by giving them the product.
Yeah. Yeah, that could
A
be.
product, I guess, whether it's a helmet or something else. I don't know. But anyway.
Okay.
Well, we're supposed to go through and look at the tables. You have that up, or should I pull up the? Here, I'll do this.
No, I got it. I got mine up here. Just gotta zoom it in here. So it's table A, right?
I think it was go through all of them. Table A through all the exhibits. So let's see. So can you see that now?
Let me make that bigger here.
Well, sorry, I just went back there, so there you go.
Okay. Yeah, I can see that.
Okay. So for all intents and purposes, they look like they're extremely profitable.
Yeah.
70% gross margins with 25% net margins. I mean, that's
yeah, that's impressive.
yeah. Yeah, so they're definitely from that standpoint, they're definitely making a profit.
Yeah, it's no wonder they thought they had a leg to stand on to go to these venture capitalists and say, hey,
yeah,
if you want to invest,
here's our terms.
Yeah. So we don't really need you. We could use you, but
yeah. So what do you think of the difference between the two proposals?
that goes back to kind of what I just said. Is I don't think that these guys really need the venture capitalists. I think it would probably make it a little easier on life. I mean, I don't know. I don't know. I don't. I don't know where they're going to use all the investment money. I mean, I said they were going to pay back some of the initial stocks and give them a bonus. I don't know how much they feel like they need to take, but I mean, I don't think they want to give up.
It sounded like in somewhere in there, they were going to do before the pre-money valuation, they were going to, in their BzzAgent term sheet, they were going to do a $3 million payout to Currents from their own cash.
From their own cash.
So they were going to do that. Yeah.
Prior to the investment.
Prior to the pre-money valuation.
Okay.
So they could pay that out without diluting their positions.
Okay. So yeah, at that point, I mean, I think their terms are a lot more friendly for themselves. I mean, I don't know why they would even entertain this other offer. I mean, you got the dividend that you don't have. I mean, 7% annually is a ton of money. I mean, I showed it on the Excel sheet that we did that, they end up taking, it'd be an extra $18 million for that $5 million extra investment. So I don't think it's
They
worth
take an extra what?
I thought it was an extra 18 million. Yeah, the value of the investor share at exit.
Oh, right here.
No,
the implied.
No, up. The value of investor share at exit. The first green highlighted cell.
Oh, this one here.
Yeah.
Well, let's see. This would be after the 5 years. Yeah. The 15 million would turn into the 55.
Yeah. So I mean, if they were to go to somebody else that would agree to their terms, I mean, there would be they would walk away with more money. It looks like.
Well, yeah. The investors get a much bigger deal, but if you go dollar for dollar, they still, honestly, I don't know that they get a better deal. So my take on this right here means to me that they estimate and expects the company to produce 67.7% annual returns. So now the board of directors and everyone on the company is expected to get this level of returns via this. So if I was the, the venture capitalist, I want this number as low as possible. To be able to get my 30% return, I want it to be as low as possible, not as high as possible. You know what I mean? Because it's more likely that I'll get my return if it's lower. You know what I mean?
Yeah, I guess that's true.
I'd much rather say, well, we only have to get 59.1% growth to achieve my goals, and then hit 67.7. That would be awesome. But if I have a goal of 67.7 and I only get 59, I might be a little disappointed. I mean, as much as can be disappointed at 67% annual return on your money, but
yeah, for sure.
Anyways, I don't know. Is that?
Yeah, I guess.
Am I understanding this right?
I guess the overall value is greater. So I was looking at that wrong.
What do you mean?
Well, I was looking at, just that the investor share is going to be 55 million at the exit, but I didn't look at the the next number down, that the Buzz value is going to be $60 million greater.
Yeah, basically by going with this route to get the same. I mean, to get the 30% for the investor side. This is for the investor. They have to increase their revenues.
Yeah, 8%.
Well, it's more than 8%. It's whatever that is, 20, it's almost 25%. They have to have a 25% greater income in revenue at the end of the 5 years than if they go the other route. That's a lot.
Heck yeah.
And as the board of directors, now I'm looking at this saying, look, the investors want us to have, we got to be making 74 million by the end of the 5 years. Okay. But the other one is saying, our expectation is you're making almost 100 million per year. It's like, well, wow, there's a lot more pressure on us now. And all because we got 5 more million in investment. I mean, this is just implied value that's already there. They're giving me 5 more million, and because of that, I've got to turn revenue of, I've got to basically build, $60 million worth more in value in 5 years. That's what I'm seeing.
Yeah, it's probably not worth the stress and the hassle of that. So,
anyways, let's go back to our questions here. I guess we got to keep going here with this. So this one here, I mean, this is just a, I can't remember what they call that, but it's just a method to determine which one's got the best options.
Yeah, his ranking system that he came up with.
Yeah. Now here's the thing that's tricky. Firm B is the one with their own term sheet.
Yep.
So Firm B is one of the top deals, and this cachette is one of the things that he was really, really wanting. And guess what? They're number one.
Yeah.
Now, if you read about Firm A, the only reason why it's really low here is because they're relatively new. So they haven't built a long-term standing.
Yeah.
To build their reputation. But I don't know. That was interesting.
Which one was it that wasn't willing to help him? Was that B?
Wasn't willing to help them. What do you mean?
That said they would only be there for the meetings and not for. They wouldn't be in Boston. I think that was Firm B. They really wanted what do you call it? Somebody involved with it. But I think firm B was in California. Yeah, they were a West Coast firm, and they said they they didn't want to have any other meetings other than their required meetings or something like that. I think that was them. So there were pros and cons to them as well in that ranking system.
Yeah, I'm not seeing the that where they're, hey, we don't want to be involved in the other portion there. I'm not seeing that, but
yeah, it's right there in the paragraph that says Balter also wondered. It said, in fact, one partner at firm B went so far as to tell Balter that they would not have significant involvement outside the regularly scheduled board meetings.
I see. Okay.
So yeah, so they hit some, but others they weren't very high on.
Yeah.
But they still had a 5 for effort on that. So I don't know how that
For which one?
for effort on term B. So
Yeah, I don't know. Honestly, looking at it, I think firm A would be the choice to go. This, I mean, their reputation hasn't been developed yet, but that doesn't mean it's bad. You know what I mean?
correct, yeah.
So
Absolutely.
anyways, so I guess we're down to the exhibits. We've got the different individuals. Everyone's, lots of experience. Man, there's a lot of money spent on advertising.
Yeah, there really is. I wonder if those are accurate numbers.
I would assume they are. $52 billion on direct mail advertising. That's just amazing.
It's no wonder people still get marketing degrees.
Yeah. Let's see here. These are their current clientele list. There's some big names on there.
Yeah, there were.
Let's see. First sequence investment by stage development. This is just historical stuff to kind of give you an idea. I guess that's all that was there for. Average valuation data.
Which one was Exhibit 5? I don't think we're going to. I think it just said discuss table and Exhibit 5.
Oh, well, here we go. So let's see. Total assets, liability. Really, this is the one that we kind of want to look at. Net income loss. So 2002 was a loss, but then 2003 they made money. 2004 they made, those are not. Let's see. Those aren't in millions, are they? I think those are. I think those are not.
Yeah, they got to be in millions, don't they?
I guess so. Let's see. Let's go back to this.
Yeah, I'm seeing some. I don't.
Current revenue is seven million in 2005. So that would be. That's not exactly, but that's net income, not revenue. Let's see, where's the total? There we go, revenue.
I don't know how you look at it like that. I had to rotate mine clockwise.
Sorry, I just need to think about it.
No, you're good. If you can read it like that, that's impressive.
So there's the revenue that we were looking at. Well, yeah, but if you'd have seen my camera, I'm looking with my head sideways. So yeah, they're looking at revenue going to 19.7 and million.
Yeah.
So, but look at those margins. They're settling right in that 25 to 27%.
Yeah.
And they're making they're making a bunch of $42,000 a year in interest, which isn't incredible, but like the fact is you're talking about a 5-year-old company that now has excess cash sitting around.
Yeah, it's impressive.
So,
which makes me wonder why they're even going with the venture capitalists. If they're just going with them for,
I think it was just to accelerate their growth, wasn't it? There were some markets that they hadn't really expanded into, and they were looking to expand into different slightly different models. You know, they had their standard word of mouth, but they had some different types of campaigns that they wanted to like expand into. Well, the next question is if they're growing and profitable, why are they raising money now?
There we go.
Can they succeed without the venture capitalist funds? Yes. What role does timing play in this decision? How much money does BzzAgent need? Excuse me. If I remember correctly, there was a reason why they were wanting to raise money. Now I have to rotate it back. Oops, wrong way.
So explain, what's the point of the venture capitalists? I mean, if you've got a proven business model like these guys do, why wouldn't they go to a bank and get a loan with with a set 5 or 6% interest and do that? What's the point of going with venture capitalists? I don't understand that.
Well, I can tell you the biggest reason. You go with a venture capitalist, you avoid the payment of interest. So you do dilute your percentage of ownership, but you don't have to incur additional expenses in the payment of interest on the loan. So, and that, it doesn't sound like a lot, maybe 5%, okay. But if I'm looking at my numbers, their numbers are so good that maybe it wouldn't make that big of a difference. But like most companies don't have that high of margins. So if I'm now taking and paying 5% interest on that, it's going to slow my growth down. Even though I got more money, now it's going to slow my growth down by being obligated to pay that. It's kind of a catch-22 in the sense that, yeah, we're able to grow slower. I don't know. I mean, you may end up being able to grow at the same speed, but now you're paying interest, and the cost of that interest is that you maintain your ownership, or the benefit of paying that interest is that you maintain your ownership.
Yeah, I mean, it seems like you would not pay. I mean, how much would they make over the course on that Excel sheet? How much would the investor make?
Versus the interest on the loan.
Yeah.
It's a totally different ball game. So at this point, I don't know. For them, it may not make sense to go with the venture capitalist. But at the same time, there's that fine line where, you may have a business that's a great idea, but if it's not, it's not good enough to get loans or whatever, and it's not good enough to do the other, and you end up with I don't know.
Yeah, absolutely. Yeah, and I can see that if they didn't have a track record and they weren't profitable. I mean, where it's more risky, but this company seems like it's got a legit thing going on.
Yeah, a lot of times they also go with venture capitalists because they want to keep their equity and those ratios correct. You know, if you go with a lot of debt, you end up with a lopsided balance sheet. And sometimes, I mean, honestly, does that really change anything? Still, you had an influx of money. It's just a matter of where it's at on the balance sheet.
Right.
But a lot of those, I mean, there is a lot. They do pay a lot of attention to how those things lay out. You know, like the company that I work for, Air Methods, they've got money to go buy the bases, the property, and the buildings, and build, you know, quarters and stuff. They don't buy any of it. They lease every single one of them. You know why? Because they already have a lot of assets with the aircraft on their balance sheet, and they don't want to skew things more one way. So they lease. At that point, it's just an expense, and it's not sitting on their balance sheet as a capital expense.
Yeah. Yeah, that makes sense. Yeah, I can see it. I didn't even think about that. So, yeah, it's interesting how many multiple revenue streams these companies could have, or not revenue streams, but options they have, I guess.
Yeah, I'm kind of scrolling down through here to see if I can find why they actually wanted.
Why they wanted the money?
Yeah.
Yeah, I remember reading it. I thought it was.
Okay, here's what it says. They were able to use cash from generated from business to fund working capital needs, but they also believed that to really expand the word of mouth space, they needed to develop additional operational capacity with a media focused team. They also wanted to buy back shares from some investors and give to the founding management a bonus. While all the key members of the management team were fully committed to the business, they thought that taking something off the table now would prevent them from being tempted by an easy early exit later on. They were also keen to consider acquisition opportunities to address domestic competition and to start a possible international expansion, and to find a few high-level manager hires, like new management hire style. So anyways, that's what they were looking to do.
It seems like you could do with that. I don't think they need $10 million for that, do they? Or 15?
Well, they were going to take $3 million and give it to their, management and the founders right off the top. So they bring 10, and that gives them down to 7.
Yeah.
But I don't know how much, it doesn't really talk about how much opening those venues and going down that road is going to cost. I mean, few high level hires, those might, they might cost, by the time you get everyone hired, they may cost $200,000 to $300,000 a piece. I tell you, that sucks up $7 million real fast.
Yeah, I'm sure I could spend $7 million pretty quick too, but
yeah. Anyway, so do they really need the money? I mean, I don't think they need the 15. I think they'd be fine with the 10. So then it says compare the investment. So let's go to that real quick. So here's the thing I see. If they get a higher valuation this route, but they lose their ownership. I mean, the Series B investors own more of the company, and so that change means that every day going forward, every dollar that they earn going forward is now less in their pocket than it would be in the other scenario.
yeah. Yeah, I mean, based on what this sheet says, I mean, it's not worth it for them to do the BC term sheet.
Yeah, I mean, I think this is what, 12.1%? Yeah, so 12.1% change in ownership
Yep.
by going this route. Not the option of it there, but still, that option pool is going to go to everybody, not just the current shareholders. So
yeah, so it's even more.
Yeah, they lose their percentage of the company, and then from there. Now it's worth more, but the reason it's worth more is because they said arbitrarily that it's worth $10 million more.
Yep.
You know. So yeah, right at that moment it says, hey, you're going to get an extra 500,000 by shares. Sorry, it's not dollars at this point, but you're going to have an extra 500,000 shares. Hey, that's great, but again, you're going to lose 12% of the revenue forevermore going forward.
12% of the share total.
Yeah, which that's a lot.
Yeah, $7 a share. That's a lot.
And then this here, it's like, well, the valuation is higher because of the share price. But the thing is in this case, if you're, they got 3 million out to begin with. So if I take 3 million out and then I have value of 36 million left over, that's still higher than this one by $50,000. Do this in the VC terms, they weren't going to get their $3 million pullout.
That's right, and then we're going to buy back any of the shares. So yeah.
So the value to the shareholders is actually less this way than it is this way. And then you have the further dilution of further earnings and so on.
Yep.
This is some of these questions here are the ones that I just don't know if I understand. So did it change my opinion? No, I don't know what you got on that, but this is the one that I found was really kind of screwy. Let's see if I can get that for you.
The second one?
Yeah. The VC term sheet describes a more investor-friendly board. I concur. How much valuation would you give up to the VC term sheet in exchange for getting the board structurally initially proposed by the BzzAgent? So in other words, what I think they're saying is that if they had to negotiate less valuation so that they could have their to me, that seems totally counterproductive. They're already getting less ownership of the company, and to say, all right, we're going to drop the valuation so we get less ownership of the company so that we can have a better board. I mean, I understand that, but like, they're already getting less ownership than the previous one, the one that they're proposing.
Correct.
That question would only make sense if they were like, well, they're giving us a greater valuation, which means more equity to us. Now let's negotiate down a little bit if we want that board to be more structured like we want it. But it's already a worse deal anyway. I don't know. Am I reading that wrong?
No, that's the way I read it too, and it doesn't make sense. I mean, the way the VC board's set up, I mean, it's very pro VC. I mean, you basically lose a lot of your voting rights, it seems like. So.
Yeah, I just said, frankly, I would not be willing to take any reduction. And then I went on, it's like, and if they wanted that board configuration, they would have to actually increase their pre-money valuation or reduce their investment amount and reduce the option pool back to the original 9%. If they raise their valuation of the company to like 65 million, or sorry, 60 million, now I'm 20%. I still end up with 20% of the company or lose 20% of the company. You know what I'm saying?
Yep.
Lose 20% by them investing. And we only have 9% on the options. So now everything's basically across the board. And now I say, all right, you want to put in five extra million over the other version? I'll give you one extra board seat. That's where, now you're bringing more money to the table. Now you got more people at the table. But like to say, we're going to fake you out with this higher valuation so that we can take more of the company and get somebody else on the board. To me, that seems a little shafty.
Yeah, I agree. Yeah, that was one of the things on the first sheet the first sheet on that Excel spreadsheet, that's the way I answered that as well. The first, I forget the way it was worded, but asked for 3 reasons why. I mean, just the structure of the board is not in your favor anymore. So.
Okay, so what's this question here? This question was using your spreadsheet, discuss the math. Okay. How do the growth expectations affect your view on what term sheet is more favorable to management? Okay, well, we talked about that.
Yeah.
That was back up here.
Yep.
Well, management's now expected to make 67.7% to get the same rate of return versus over here with 59.1. So management's going to want the lower one because it's easier to meet that expectation.
Yep. It's still huge no matter way you look at it. But.
Yeah, I wish I could get that much growth in profit. I mean, I guess it's revenue, I think, is what they were looking at there, but that's still a lot.
Yeah.
So go to tab 3, compare your responses. All right, let's see here. So what did you have? What did you have in the? We got all the same here, I assume, because it checks ours. But what did you say in this last one? The question there.
Let me see. That's so it says the price per share of the VC term sheet is close to that of the VC term sheet, but it's as the current value is different. Well, it's because they're diluting their shares. They're not getting as many shares, is what I put, in a sense. So.
Okay.
Which is more.
Yeah, mine was basically it's higher because they got a higher valuation. So they split instead of 40 million, they split 50 million. So that's as far as that goes, but they're doing it to a smaller number of shares.
Yeah, their shares aren't worth as much, or there's more shares.
Yeah.
You're getting a smaller share amount.
Yep. All right, let's see. What do we got next? Yeah, basically this one it boils down to is that there's a lot more shares and there's a lot of money value sitting in those options. There's 17%.
Yep.
That's not being divvied up into the other. So you've got more total shares and more total money. So it works out to about the same deal, but the per investor amount is smaller. I mean, it's actually bigger, but it's because there's the higher valuation. So.
Correct.
So now we're supposed to read this next deal here, and this is probably where we need to spend most of our time, and we're kind of running out of time here, I think. But anyways, did you read through this?
I did a little. I skimmed it because it sounds like it was just the same thing as what was in the case study.
Yeah, it looks like there was a little bit more information, but basically the same. Because they did, in the other one, he didn't discuss D, I don't think.
Oh, yeah, that's true. I didn't notice that.
Yeah, I don't think he discussed that one. So anyways, as a group, decide which offer you will take, if any. Create one Word document. To state your decision, explain. This should be a brief document, and then one person use that assignment to submit you for the group. So do you want to do that? You want to pull up a document?
Yeah, I can do that. Let me get the document.
I can stop sharing my screen here so that you can actually see yours for that.
Let me save it here. Revised Buzz. Alrighty. Let me just share. All right. Can you see that?
Yeah.
All right.
So this would be our raising capital at BzzAgent B, or portion B for you and I.
All right. The firm I thought from the beginning was firm A.
Yep, I concur with that. You know,
I like them that they're on the East Coast with them. They're willing to be involved. They were willing to agree to their terms. They were nice. They were friendly. You know, they're new. They got a lot to show. I think they were going to be able to work the hardest for them.
yeah,
So.
and based on the finally, Cachette was important as it would help us acquire top tier talent and open doors previously closed to us. Well, you know what? I think by virtue of their business doing well, they're going to open those doors eventually anyway, and they're going to hire that top tier talent the same way. I just don't see that being even if they're not as for me, the value added, the chemistry, the domain expertise, those are the kind of things that are most important. I definitely agree with firm A.
Okay.
So what are we supposed to answer here according to our deal? Create one word document, state your decision, and explain your reasoning. This should be a brief document.
So we firm A decisions.
I can't remember. Is he on the East Coast?
Yeah, I think he said he was in Boston.
Okay. I would also say that I don't know, if you're on the same page with this with me, but I think the Cachette, which is the one that they were rated the lowest as far as across for their board, I think by virtue of the company being progressing so well, they'll be able to attract that top tier talent regardless of who they pick as their venture capitalist, as their investment.
That's a run-on sentence. Not be an issue.
I would just say would not be an issue due to the successful nature of the company. Period.
Yeah.
Yeah. Their business will attract their success will attract the top tier talent.
All right. Think of anything else?
No, I mean, I think they're right at the top with everything else. And if we downgrade really, I think we've said it, but if you downgrade the importance of cachette, firm A stands out like head and shoulders above everybody else. I mean, let's say if we said cachette was only like 50% of its regular value, at that point you've got what, 5, 6, 7, 8 plus say 4.5 for the others, so 12.5 divided by 1, 2, 3, 4, 5. So now they're at 2.5, but you do firm B, which is the next one closest, and now you're at 5, 3, 5.5 because we'd half that again, and 3, 16 divided by 5. So now you're 3.3. I mean, so there's like, they dropped from, just by taking that cachette and making it 50% of the, as effective as what it currently is in his list, they dropped substantially. And there's nobody else in there that would be even close to them in that regard.
Yep.
I don't think we need to verbalize that in our sheet, but
okay.
Anyways, so I think if you can submit that, only one of us does. One person will use the biz to sign the sheet. So
yeah, I'll just submit that with my other one. I guess, where does it say to submit it?
There's actually a separate tab for it.
Is there?
So yeah, so under the BzzAgent one, BzzAgent's case. So we're doing the BzzAgent discussion, okay, and then the BzzAgent decision right below that is the one where you submit that. And then the next one down is the post-discussion poll, which we would do that quiz. So for me, I'm just going to mark the BzzAgent decision done because you're submitting it.
Okay, perfect.
But the week 6 BzzAgent discussion topic is where we post the link to our video.
This video, okay. All right, that assignment is submitted right now. So
cool. Well, feel like you're knowledgeable in VC capitalist.
Yeah, not quite, but
you know what? The thing that's got me thinking is, man, if you can get past that initial, like get some seed investment enough to build a business a little bit, the fact is the real wealth is created. I mean, let me just say a large amount of wealth is created actually in the next round of getting investments. When you've taken say you get $100,000 and you build a business and you're like, all right, here's my $100,000 business, and they come and they do an evaluation I should say, well, it's worth $1 million now. You're pre-money, your 100,000 just turned into $1 million, and you didn't sell one single product more for it to go from that 100,000 to the $1 million. You know what I mean?
Yeah, correct.
Like it just boom. All right, well now I'm a millionaire. All right, cool. Like, it's like mind blown. I mean, holy smokes. All it did was just change your stock value just a little bit, and now all of a sudden your business is worth a ton more. I mean, theoretically you've built that value, but the fact that you don't have that money, if you'd have gone through and just kept going with sales to get up to $1 million in sales and profit from that, it would take forever. Not in that, not if you're making 75% margins, but
yeah, that's true.
If you can be relatively successful, I guess is what I'm getting at, is if you can be relatively successful at building a business, you don't really have to run it. You know what I mean? You just have to, all you really have to do is just make a business that has a good business model, and then, open it up to investors, and boom, you're going to be, you're going to make a bunch of money, and then you move on to your next idea.
Yeah, and you could do it at the same time. So
I don't know. I mean, that's just the thing. Like, we talked about I mean, maybe I'm overthinking it, but it just seems like it's just the real value. The long-term value comes in the sustained, selling of product and whatnot. But the real explosion of value happens because of the next round of financing. In that higher valuation, getting a high valuation for that next round of financing.
yeah, but I mean, how do you do that without diluting all your shares as well? I mean, well, I guess if your valuation's high enough, it doesn't matter what the share, how much.
Yeah, I mean, the thing is if I have $1 million in shares, let's say let's just do hypothetical. I build a business with my business model, and I start generating revenue, and I sell myself a million shares, and you come along and you say, you know what? Maybe that million shares only cost me, $1,000 or whatever it was that I initially invested my money of. Okay. You come along and say, you know what? I'd like 1 million shares, but I'm going to invest $2 million. Well, now I only own half the company. So I went from full ownership of the company to half owner, but my shares all of a sudden went to $2 million value. You know what I'm saying?
Yeah. Yeah.
And I was using an extreme example there to just kind of make my point. But yeah, so I lost 50% of the company, but I went from my initial investment, which was hardly anything, to now I'm worth $2 million.
Yeah. Yeah, it makes sense.
And part of the reason why that explosion happens is shown exactly in this little case. You look at that Excel spreadsheet, they're basically saying that the value of the company is 2.5 times, they're projecting the value at 2.5 times the current revenue or whatever, you know what I mean?
Yeah, correct. So they're already going to make 2.5 times what, yeah.
That's 250%. And that's not uncommon. I mean, honestly, if you look at earnings per share numbers for most stocks, earnings per share is somewhere, Apple's like 60 to 1. So if I had built Apple and everyone thought it was going to grow like crazy, for every dollar that I'm currently earning with that stock, they're going to say it's worth 60. I mean, that's just absolutely mind blowing. You know what I'm saying?
Yeah.
Because you're not, I make $1 and they're going to say, well, the business is worth 60. So, you don't have to be making that much money to have something that starts turning really, to something big.
Yeah, that's for sure.
Even though you may not be be able to pull that much money out, at that time. So anyway, it's just something I've just been thinking about. Like, I really like building ideas, and like, I mean, that's part of the reason why this is, my core emphasis is entrepreneuring. Like, it just like coming up with the idea and putting together that, like, the tediousness of actually, like, afterwards, that just doesn't float my boat. You know what I mean?
Yep.
But I think if you could, like, go through that process and just build a good business model and then pass it on to somebody else and get paid a big chunk for it, then they can struggle for the next several years, like trying to make sure that they keep their revenue going up, and then they figure out all the nitty gritty details about, management and how they can fine tune this and whatnot. Like, I don't know. I mean, you're still gonna have to do some of that, but it's just, it seems like that initial part is the more exciting deal, and then after that, it becomes kind of a, I mean, I'm sure there's exciting things at Ford Motor Company, but
it's
Ford Motor Company value isn't changing very rapidly. You know what I mean?
Yep.
It's pretty much, it's stayed the same for the last 15 years. I mean, it's, it's up and down a little bit, but it's not like going from, like, a couple million to, like, hundreds of millions in 5 years, kind of a growth.
Yeah.
But anyway, cool. Well,
all right. Well, I don't know if you saw, I posted the link in the chat.
I did. I saw that. I appreciate that. Yeah. I'm glad it worked out. I wouldn't have been ready earlier this week, and
yeah, there was no way I could have been. So,
and they document the grading. If you, like, hit that post discussion poll and said I wasn't part of the group, I mean, it cuts you pretty hard.
It does. I actually emailed the teacher about that because I wasn't able to make last Saturday either. And so I said, is there any way I can make it up, make my own video, whatever. He said, no, don't worry about it. It's not weighted very heavy.
It's a lot of points.
It is a lot of points, but they must not be worth very much overall. So,
yeah.
Yeah, he said missing one or two of them isn't going to hurt you. So.
Yeah. Cool. Well, you have a good weekend. Hopefully you have a good Sabbath. And,
yeah. It's my first weekend off in 2 months, so I'm looking forward to it.
Yeah. Cool.
All right, Barley. Have a good one.
You too. Enjoy. Bye.